It's the second week of September. I hope you guys had a great Labor Day last weekend. I've missed a spot on my face while shaving, like this whole spot over Labor Day. So we kept it going. So here we are. It's not your screen, I promise. And it won't be forever. It's just having a little fun. A lot of gray hairs. It's a little thicker than it really looks, but the reality is, it's showing the age. So enough about my hygiene or lack thereof. Let's talk about this week. It should be a pretty quick video this week, guys. Here's the rates are up still. We all know that. But here's the deal. We actually were making a good little run. Even the jobs report last week wasn't bad for us. And then all of a sudden, like reality sunk in. And now it is like Monday, Tuesday, Wednesday, Thursday, here we are down here. We hit the night. We warned about this last week. Look at that black 50-day moving average, right? So take it back. We knew we were pushing up against it. And that thing's been formidable. It's been hard to break. So here we are back down. Some of that has to do with Fed members just saying the usual noise, but the reality is, hopefully I think we'll unfortunately see higher rates the next day or two. So it is what it is. I think we'll drift back down, which means rates are higher. I think we'll see rates here in the higher next couple of days. I'm thinking and hoping here over the next 30, 60 days with new job reports and new inflation reports, we might see the turnaround and maybe get momentum to break it. So here's basically what was said last week or what was reported last week for the jobs report. If you guys want to push past and look at this, more power to you. You're better than me. The reality is, look at the trend, 3 month, 6 month, this middle table, if you will, the 2022 average, the 12-month average, the 6-month average, the 130-month average, or the 3-month average. You guys can see less and less, fewer and fewer jobs, right? So that's the trend as we are going down. People are losing jobs, unfortunately. Matter of fact, the revisions that came out, this is the second line on the top chart. The past 2 months, they adjusted it and said, hey, just kidding, over 110,000 jobs were lost. So jobs are trending down. The hours, they're holding about the same, but you guys can see the average hours worked is 34, not 40, right? So people are working less, taking pay cuts, whether it's, in terms of dollars or just hours worked. The trend is happening. So it will eventually come in to show it, it takes inflation down, it takes spending down. But right now, along those lines, you guys can see the unemployment rate's gone from 3.5 up to 3.8. So it is increasing. And again, more stuff you guys can look. I'm not going to go through this, but you guys can push tip. But, the reality is, guys, for buying homes in the real estate industry, so if you're watching this, you're a realtor, builder, whoever you are, I've said this before, and CNBC must be running out of things to write about because they basically reposted the same article that we've been preaching about for, I think it was like 4 months ago, where 5.5 is like the magic rate that everybody's going to come out of the woodworks to buy a home. So again, the part that we can just drive home, guys, is understand that homeowners are out there, or future home buyers are out there. They're hiding. They're just not doing anything right now. Know that 5.5 is the magic number that gets people to jump. So if you're a builder, offer some buy downs to maybe get to 5.5 and advertise it. If you're a realtor, tell your sellers to do a buy down, right? If you guys don't know what that looks like or how it works, obviously, shameless plug, mortgagemark.com, search up buy downs, and it shows about temporary buy downs and things like that. But ultimately, that's the one that's going to make people move. And look at this. This is the Fed funds rate. So not interest rates, but the Fed fund, what they control. When the Fed raises rates, this is what happens. Look at this for the last 20 years. It's wild. And you can see the gray. I don't know if you can see it on your screen or not, but it is a gray section. Every time they raise the rates, you'll eventually see that recession come thereafter. Look where we are over to the right. Have we peaked? Probably not. There's Fed members saying they still want another 1 or 2 hikes. But that recession, we'll see how big that gray line gets, right? You can see how big it was back in the 08, mortgage meltdown time period versus the 2020 COVID, recession. That was just a blip on the radar. So we'll see. Recession's coming. Here's the other reason why I think recession's coming. We've said this before many times over the last couple of months. It's amazing, but Americans have $1 trillion in credit card debt. That's a lot of credit cards. Average rate is 22% of interest, which is nuts. So there are a lot of folks with equity out there, home equity. So yes, shameless plug. And I don't want somebody to give up a 3% rate if they can help it on their mortgage. But when you're paying 22% on credit card debt, maybe it is worth it. Depends on the scenario. But what's funny is the travel and the clothing is still going strong. So even despite all these big balances, people are still spending. But at some point, credit limits will be hit. Spending will stop. That, again, will further inflation coming down, which will help mortgage rates. So what I would say is, you guys, get a budget. And that's not what this screen says. But if we got $1 trillion credit card debts, if you guys don't have a budget, man, I'm passionate about that. Feel free to call us. We can even do a video if you guys need or want or something about that. But have a budget. And what budget do you use? the one that you stick with. It's like what diet works, the one you stick with. So whether it's keto or Atkins or whatever fads out there, just stick with it and you'll do better financially. And so I did see this article. I thought it was fascinating, and it's from the Wall Street Journal. And I also read Think and Grow Rich. If you haven't read it, or if you're in the business world, dude, it is a great book. And in that book, I just remember being blown away by the same stat that this says is basically this article coined it to 53 years old. People make the financial mistakes, the most financial mistakes before the age of 53, and 53 is when you're like on it. That's the peak. And I remember Think and Grow Rich said the same thing. It's like your 40s, you're starting to come around, but the 50s is really where it's like you start making really good decisions because you've had enough, problems in life and figured out what's going on. That you're kind of like, you're in the zone, so to speak. So all that's to say, I just thought this was an interesting article. You guys can see about the optimum time, what it takes, and financial mistakes. It's a great article. Read some of these stats. It's fun. So guys, get social, share, like, subscribe. I've had a lot of great comments about, hey, we're watching you and doing this. So thank you so much for doing that. Take the moment and just share whatever you can. We really appreciate you, and hope you guys have a great and wonderful rest of your week. Bye-bye.